and because we have weekend risk, we don't know what's going to happen on Monday morning. We put these Qs on in order to manage our downside risk here. Now we've got quite a bit of room to run, and actually this is not an accurate picture, because if those Qs start to, if we do go down, those Qs are going to increase dramatically in price and give us a fairly substantial profit. If we go back up, and we go up 100 points, boy, we're still looking very, very good here. And what we'll do is maybe that insurance policy, this entire insurance policy on the Qs, I call it an insurance policy. I mean, even insurance companies have what they call reinsurance companies, where they go out and they take on insurance policies to manage their risks, and they go to a reinsurance company. So that's what we're doing. We're taking on insurance for the weekend. If we don't need it, guess what? We're only holding it 2 days. We're going to sell it out on Monday morning if everything looks good and prices are stable. Then we're just going to take that insurance off. We'll say thank you very much. How much did it cost us for the 2 days of insurance? Cost us $100. Oh, okay, no problem. We can give up $100 of profit if we go up, right? Because if we go up, and the longer we can hold this position, we're going to accumulate another $1,000. Let's say we ended up right here. We're going to accumulate another $1,000 in profit. So we can afford to spend $100 for that insurance over the weekend. Believe me, it's worth it. Okay, this is a bit of an advanced technique, especially going into option expiration week. But especially during option expiration week, if you haven't closed out your positions and you've got positions going into expiration, now you've got price risk more than any of the other risks I was talking about. At this time, this is the point where you do not want to allocate any new capital. It's too late for that. Now the thing that you need to do is manage your price risk. And if you have to give up some of your profits in order to have that safe, that security of mind that your position is not going to get killed if you have price risk, well, then that's what you do. And that's basically what we're doing. We're going to give up a little bit of our profits to buy ourselves some insurance, and when we don't need the insurance anymore and things look like they've stabilized, well, then we're just going to sell out our insurance policy, say thank you very much. It's worth the $100 that we paid over the weekend to have that insurance policy, but we don't need you anymore. We're back, up. If we go up, we're back up towards the center. If we go down, we cash in our insurance policy, collect a nice profit, and close out our positions for the month, and we go on to our next month's position. Now, how much money can we make? Depends on how much the market falls. If the market falls dramatically, this is not an accurate picture because it doesn't take into consideration the volatility that the short-term options are going to face and experience, and also the delta change. So remember that this is actually probably, if we fall a couple 250 points, we're probably going to be closer to a $1,200 or $1,300 profit here, and then we'll just close all of the positions out. That's one thing that this will not analyze. So not only, if we did not put these on, what would happen? Well, if we get down far enough, we could be in a position where not only we're losing money on the current position, but even at expiration we could get to the point where we're losing money. And what do we want to do? Well, we don't want to lose money. So in order not to lose money, we manage our risks, and that's how we manage it. So that's it for today. Hey, this is how professional traders will look at their positions. They will manage the risk based on the type of risk they perceive in the market. The great thing about the market is that, and especially options, is they're highly flexible. There are all kinds of things that you can do to manage your risk, but it is a business, remember. Every business is going to manage their risk, whether it's the bakery who has to buy enough flour now to last them for the next 3 months so that they don't get hit with a huge price increase in 3 months, or it's your business, your trading business, that has to manage their risk so they don't get hit with a huge downdraft in the market on a Monday morning while you're holding your positions over the weekend. So that's it for today, guys. I wish you all the best, and I will follow up this with a second video on Monday morning after we take a look at how price action is opening on Monday morning. All right, trade with confidence, guys. Morning, tradeologists. Okay, today is Monday, May 12th. And what we're going to do is we're going to take a quick look at our trades for today. Now we're going into expiration week, and as I mentioned, we had a little insurance policy on the QQQs just in case we get a big drop in the markets over the weekend. It cost us $65, but that's cheap insurance because we're already up over $140 for today. We have an open profit of $935. And let's take a quick look at our analysis tab. That $65 insurance was well worth it because we made up more than that just in the profit today as we opened, and it really didn't cost us anything at all, and the insurance was very, very good for us. So here we are today. Like I said, we're up $135. We are moving back towards the center very nicely on our position. We're going to keep a close eye on this position. Of course, we are in expiration week. I normally like to get out earlier. However, we're going to try to squeeze every little bit of profit out of this position, out of our positions as possible. We have the positions on the diamonds, the EEM, the IWM, and the SPY continuing to go. Let's take a look at each individual position just for a second. But before we do that, let me just show you something. We want to take a quick look at the VIX. And let's take a look at where we are. We have we went up here a little bit. If you can take a look down here in the corner, we're going to take. We've been dropping significantly. I thought for sure that I didn't know for sure, but I thought possibly we could jump up here and retest this level up here around 21.50, 22. And that didn't happen this morning, so that's why we closed out our insurance. We bought the QQQs as insurance. And we closed those out early this morning when we saw that in fact the market was not going to drop like a rock and retest those VIX levels. So we're back. We're falling back down again. I think we're going to retest these 18 levels, so we should be up for the day. We'll see exactly and keep monitoring our position. But at this time, we don't really have to do anything. As long as we stay to the upside, we've got plenty of room to move to the upside here. We're going to continue to make a profit on this position today. We should be close to $1,000 in open profit. Now remember, we're only trading 1 or 2 contracts here, so this is a pretty good profit. And all we had to do is just kind of be patient, wait. And now this white line here, which is our current profit and loss position, is joining the expiration green line here, which is only 5 days away now. Let's take a look at our monitor tab here, or our trade tab. We can see there's only 4 trading days left in this position. Ideally, we'd like to be in the center, and all of our positions would expire absolutely worthless, and that will give us the maximum profit. So we just have to sit back, relax, going to monitor. Now, normally during a trade, when you're putting on trades 30, 40 days ahead of time, you don't really have to be that concerned with the day-to-day kind of market fluctuations. But as we get closer to expiration, that's where you really want to pay attention to your position. So that's what we're going to do if you want to extract as much profit as possible. However, I do not recommend holding positions into expiration week. Price is the biggest risk during expiration week. Let's just take a quick look at our monitor tab for a second and take a look at our numbers. Our delta is a very nice little positive 94. Our gamma is a negative 190. And all gamma really means is that it's the amount that the delta is going to change based on the position, overall position. Theta has increased to a nice $129 a day. So going into expiration week, we should expect to collect another $128 every single day that we're in expiration. And our Vega is at 121, and it's a positive number, meaning that if the Vega goes up, we will increase our profits by $121. However, given that delta is also a positive number, that they kind of neutralize each other there. So what we want to do, and our current profit open is 925, and we want to just take a look at our Analyze tab here for a second. As long as we can continue to move up, the Dow Jones is right now is up about 30 points. If we continue to move up, we'll be doing very, very nicely here. We're going to keep an eye on the market very closely. We want to be able to stay in this center position. All right, tradeologists, hey, trade with confidence.